Welcome to the Perkins Coie Emerging Company video seminar series. This is our first of 6 videos discussing the steps necessary to get an emerging company off the ground. Before we jump into the substance of formation, which is the subject matter of this first video, let me first introduce Perkins Coie. Perkins Coie is an Am Law 100 law firm with approximately 700 lawyers in our 13 offices in the United States and 2 offices in China. My name is Buddy Arnheim. I'm the chairman of the company's Emerging Companies Specialty Group, which is a group of approximately 80 lawyers that spend most, if not all, of their time working with emerging companies. And just for clarity, emerging companies in our mind are companies that are pursuing perishable market opportunities and typically have several similar characteristics. First is they're growing very quickly in order to take advantage of that perishable market opportunity. Second, they typically seek outside or external funding in order to fund their initial product development and market entry. And last, perhaps most importantly, they're built around 2 core assets: the human capital moving the business forward and the intellectual property around which the business is being built. So in this first video, we're going to talk about forming the emerging company. And in subsequent videos, 2, 3, 4, 5, and 6, we're going to talk about the founder's relationship, the relationship of other persons, some day-to-day things that happen in the early days of the emerging company, intellectual property, strategy and hygiene, and the infusion of seed capital. With respect to formation, in the United States, there's generally 3 broad categories of entities that one could select. There's the nonprofit entity, and we're not going to talk much about that here simply because most emerging companies that we are working with are seeking to make money, seeking for-profit businesses. But there has been a slight trend over the last 5 years or so in which emerging companies have established some aspect of nonprofit contributions that fund philanthropic efforts to the extent the emerging company itself is successful. But the 2 types of entities that we see frequently and talk about extensively with emerging company founders is the C corporation or the tax flow-through entity. The C corporation is a classic corporation that many of you just know by name. And the characteristic of a C corporation is that it's viewed from a tax standpoint as a living taxpayer, meaning that if the C corporation makes money, it owes taxes on that money. And then if it wants to get those earnings out to its stockholders, it does so either by a dividend or a redemption, the receipt of those dividends or the receipt of the proceeds upon redemption are taxable by the recipients. So there's a double layer of tax there. The tax flow-through entity, examples of which include a limited partnership or a regular partnership or a limited liability company, are not viewed from a tax standpoint as taxpayers. Instead, the stakeholders in those tax flow-through entities are deemed to receive the income or loss generated by the entity and owe taxes on it. Thus, there's only a single layer of taxation there. And intuitively, you might think, well, boy, an emerging company would more likely want to be structured as a tax flow-through entity in order to take advantage of that tax benefit. However, we see the opposite. We see most emerging companies forming as corporations. And the reason for that is twofold. First, most of the emerging companies we work with seek external funding and are likely to procure it from institutional investors such as venture capital funds. And those venture capital funds have a bias either because of tradition or because of restrictions they have vis-a-vis their own investment agreements with their investors to invest in C corporations. Once in a while, though, we will form an emerging company as an LLC with the expectation that it can take advantage of the tax flow through in the early days and switch over to C Corp down the road. It's feasible. It's for creating an LLC versus creating a C Corp is a more expensive process. Because the laws and the rules governing a C Corp are so well defined. But that does happen from time to time, particularly if there's an opportunity to take advantage of that tax flow through structure. In addition, we often, to the extent a company is formed as a C Corp, that company may have the ability to file what's called an S election in the early days, which is to say that they file a form with the IRS that says, hey, we formed as a C Corp, But we'd like you to treat us, from a tax standpoint, as a limited partnership or as a tax flow-through entity. In order to qualify for an S-corp election, or in order to file an S-corp election and qualify as an S-corp, a form needs to be filed with the IRS, and certain characteristics of the entity must exist. For example, you must have fewer than 100 stockholders. You must have only one class of stock outstanding. All stockholders must be individuals, and all stockholders must be U.S. citizens or residents. I would encourage you to talk to a tax expert on this specific issue, but hopefully that highlights for you the option. And again, the idea would be to form as a C Corp, which is the most typical vehicle we form for our emerging companies that are expecting to raise external capital. And to the extent there's a value in flowing through the profits or losses in the early days out to the stakeholders of the business, filing an S election.